Here we go. Jacket, shirt, no tie. We're in Florida. Listen, I want to welcome you, my friends. Let's get this fixed, this camera. There we go, a little bit better. I'm going to try to keep this short. I'll do my best. The subject for this PK, of course, we're going to talk about for out of the box, why diversification doesn't work. Now, I'm sure you're going to think, PK's lost his mind. Well, you wouldn't be the first person who thought this, but let's say results to the speaking. You have to think for yourself and see what the reality is. And remember, I got over 35 years of not only trading, I've managed a family, a trust fund for over 5 years with a nice substantial amount of money. So I have experience in this. Of course, got lots of friends who hire financial planners, all sorts. They call them this. They charge 1%. And, and they always say, hey, PK, will you take a look at my portfolio just to see what you think? And the first thing I want to tell you is that, number one, they always talk about this asset allocation. I know, remember, we're not talking trading here. We're talking about your IRA, your long-term retirement account. And let me tell you, whether you do it yourself or you're paying somebody, they always talk about what is your asset allocation, meaning what percentage are in stocks, what percentage is in fixed income. And you'll find out that the typical portfolio, it's like your age, under 40, is 60% stocks, 40% fixed income. And I want to tell you that this is wrong. Where managing your portfolio becomes difficult is when you become my age, 60. I use that expression, when you're an old goat like me. Anyway, and you can say, well, why, PK? It makes sense, right? We know, don't put all your eggs in one basket. But I want to tell you the following. I've lived through, 35 years of disasters of the market going down, and I can tell you from firsthand experience, I don't care what you're diversified in. Remember, the whole purpose of diversification is to protect you from market collapses, from crashes, right? But the fact of the matter is, it doesn't. And so the whole notion of diversifying your portfolio, your stock portfolio, in this fund, that fund, short bonds, long bonds. I'm telling you, when the market really falls apart, whether it was last year, you look for yourself. Whether it was last year, the pandemic dropped 30%, 2008-09, the flash crash. I'm telling you, when you have a market drop, everything even the gold and silver can drop. It happened at least temporarily. And so you really don't, it's not supposed to drop. Depends what the disaster is. But usually when it's a financial disaster, which is the majority of these things that have happened in my 35 years, something with the Fed, interest rates, who knows what it could be, a housing crisis, bailouts like what happening now. I'm telling you, you see for yourself. Take a look. If you have a portfolio, go take a look at your statements. And don't you tell me, prove PK wrong. Show me how that diversification helped you last March and April. It didn't. And this is typical. So why are they doing it? Why are they diversifying? If it doesn't help you, I can only come up with really two reasons. Number one, if you're paying somebody, 1% a year management fee, 0.75%, you're paying a financial advisor, a certified financial planner. And it looks very good. You get your quarterly statements. I've seen them. I saw them what they did with my family's trust fund. They were with one of the major banks. I don't want to say who it was in New York for many, many years. And when I saw, this, it must have been 30 things, 40 things. I couldn't believe it. And yes, when the market drops, some things go down less than others. But this is not diversification. For me, diversification is when one thing goes down, the other will try to protect you. It's not a perfect hedge per se, but I don't see any purpose in diversifying nothing, because they all go down together. When you really need it to help you, it's not there to help you because you're too correlated, including the metals, I said at times. So, and the other reason is why everyone do it. Because remember, the business has changed over the last 20 years. Now the advisors, they used to get some commissions from you. Now they're getting paid from, if they put you in an annuity or whatever they put you into, the company is paying them. So it's not costing you. But since they have control, you want to trust them and say, oh, we have to diversify. I'll put you in this fund and this and this and this and this. You're fully diversified, nothing to worry about. Well, we want you to pull your statement from last year and you can tell me what happened. You'll see everything went down, and a lot too. It wasn't even like one asset class even saved you. None of them saved you. So why do it? In fact, if I can remember the saying, there's a saying, we know that don't put all your eggs in one basket, but I want to tell you, put all your eggs in one basket and watch that basket carefully. I can't remember who said it, one of the big traders, but it's a classic line. So what I mean is this, is that, regarding the diversification aspect, if I had a retirement fund, which I don't myself because I'm a trader, I trade my own money differently, so forget me. I'm not in the mix here. What I would recommend, is that, look, you can buy index funds. In fact, even Warren Buffett talks about this. All you need to do, you don't need to hire anybody. I think Warren Buffett admitted all you had to do 20 years ago is buy the SPY, S-P-Y, some index fund, open your account at Vanguard or one of these, Fidelity, one of these companies, and you can buy the SPY, which is a S&P 500 index. Very low cost, such a low fee. Or if you want to buy some SPY, some NASDAQ, so we know the more money is made in the NASDAQ with the technology section, by the Qs, the QQQ. This is another index fund. Or if you want to buy the Dow stocks index fund, you buy the diamonds are called DIA. So, but just know, let's say that if you want to go a third NASDAQ, the Qs, third diamonds, and third SPY, don't think you're diversifying. This is the point I'm trying to make. So I'm telling you, diversification is a myth. It's I'm trying to think of a stronger word. It doesn't work. Don't do it. Not necessary. Especially when you're paying somebody to do it. Don't let them impress you. Look what I did, 2% this, here. Now what you can do, which, since now the technology, we all can follow on our phones and the stock, we can follow the stocks much more carefully, is that, yes, you can take a couple index funds, whether it's the SPY, the Qs. I recommend one of those major index funds. Forget about everything else. Believe me. That's all you need. But let's say you want to take 20, I would take 20% of my portfolio. And remember, you're adding money every year to it, right? And then pick some stocks that you're going to keep, individual stocks that you believe in, that can really, maybe, even if they're speculative. This is how you can boost your overall return. You don't have to pick, over the time, especially your age, in your late 20s and 30s and early 40s, let's just say under 40, pick some stocks Keep them. Don't trade them, but things you believe in. Not for the what do you call it? For the return, for the dividend. I'm talking about picking stocks that can really make a difference. And if 20% is too much, then you don't want to risk that much, then pick 10%. If you want to try to boost your return over the time, because you pick a couple big winners over a 20-year period, you really can be set for retirement. Anybody do this? No. What they do is they you'll see. Take a look at your quarterly statement. I'm in 20 stocks, 1% here, 2%, 4%. Oh, I believe in this. We'll buy a little bit more. Across the board, you know what? You're paying all these fees, which you don't realize, for nothing, and you're not diversified. And all it's giving you is this false sense of confidence that you're safe. The second issue is, so that's my take about diversification. The other big, where everyone's doing it wrong, believe it or not, again, is in this asset allocation model. 60-40, half in the stocks, half in in your fixed income. Now, last couple of years, interest rates are YB in bonds. They're paying 1%, 2%, a bond fund 3%. So, but I'm just talking about it in general, right? The problem is when you're young, when you're under 40, I would define this. I think it should be 100% in the market. No fixed income. Because you're going to keep it 20 years, 25 years, 30 years. And the problem is, when the market, you get this big market, as you know, 70% of the time market keeps going up over time. As you know, the books say this is true. What are you putting 60% in and half for? You want to be all in, and sure. And even if you're dollar cost averaging on the drops, it's okay. There's nothing wrong with this. I think this is a good strategy too. The mistake everybody makes, the advisor, your financial planner, or yourself, you think you can't have it all in the market. You think you're taking too much risk. But I'm telling you, the problem is, if you go 60% in the market and 40 or 50%, when the market goes up and you get these big uptrends like we have over our generation, your generation, look what happened in the last 10, 12 years. In fact, even the market's still going up. The fact it might come down, it'll be just another buying opportunity. You don't make enough. You don't have enough money in the market. So even when you get this great run up and great uptrend like we had since the bottom of the financial crisis, you're not really making. It's that same old thing of going for 3-to-1 if you're a short-term trader. You make something, not like you're losing, but again, you're taking this big risk of these disasters that happen once every, 10 years, 15 years. All of us will face some financial. We're going to face this. They use that word volatility, which is funny to me, but what it is the market crashing temporarily, or in 2008 in the financial crisis, it went down for a couple of years, 50%. And so again, yes, if you have all in the market, you can say, well, PK, what happens? I went all in 2000. Let's see, did the worst thing possible. You started your retirement account in 2006 at the high, okay, and all in, okay. So it dropped 50%, but you're not getting out. In fact, you're not getting out. You're keeping it for 20 years. You can't. You don't even have to watch it. In fact, if you have some money if your dollar cost averaging is even better, you'll be buying some stock, especially if you're picking some individual stocks that you like or that are coming out. So, you see, look what happened. Look what PK does. PK doesn't want to shut up. I can't help it because it's so wrong. It's such a simple fix. Yet you're never going to see anyone discuss this on any financial show, any TV show, any book. You'll see diversify this, foreign stocks, intermediate bonds, short-term bonds. Sounds good, reads good, but in the reality, they all go down. They don't save you. And I'm telling you, and then when the market goes up and you get these big moves, which you're going to have in your 20, 30-year hold, when when doing your portfolio, you don't have enough in. See, again, do you want to be average? Everyone who thinks, I'm thinking out of the box, I'm diversified. This is thinking out of the box, living out of the box, putting it all in. And putting in 2 or 3 things, some index funds, you pick a couple of stocks that you love and sit there. Forget about it. One other point, I'm already gone 15 minutes because it's important. If you're hiring somebody, you always say, PK, how do I judge the advice? What's your metric? How do I judge if the guy's doing well for me? I'm not sophisticated. I don't know these things. I'm focusing on my career. Nothing to do with the financial business. I trust this guy. He's recommended. Or he's at one of the big firms. There's nothing to do with this. Don't forget. All they got to do is don't forget. This is not like becoming a lawyer or a doctor or a CPA. You can say, what does it take to become a certified financial planner or a investment advisor? He's got to pass the test. Like going to driving school. So maybe you got to study 3 months, 6 months, take your SAT. They're not taking a 4-year degree, 6 years degree to be a real professional and going to school for these things. It's they can maybe get it in 6 months, 8 months, 3 months. There's courses. And that's why it's so easy, to become a financial planner. It's a great business. If you're great in marketing, easy to pick up clients. So the way to analyze these things, I would analyze if I was to hire somebody and didn't know, I'm not a trader, no experience. Everybody compares how they're doing, and you'll see this in the paper, in the financial paper, and they'll see this on the financial news shows. Everyone, they get the guests on. The S&P was up down 12% this year. I'm only down 8%. You're still down. You're a loser. What's to brag about that? So you outperform the S&P, and then you'll find out too. There's a million articles. When you have the Dow, when the S&P is up 20% that year, how many of these managers underperformed? This is Warren Buffett's point. That very few people, on these great years in the market can outperform the S&P, but if you're in the index, whether you're in the SPY, the Q, or the diamonds, you'll be fine. You're gonna do better. I don't know, some high percentage, 90%. I think, I don't know exactly the number. You can look this up for yourself, what percentage of people, of the professionals. But, that word, professional in what? Taking a test, getting a license, Series 3, Series 7, whatever the series license, they got Series 63, sell annuities. What kind of education is this? Any of you getting a real estate license takes big education? It doesn't. But they give the impression to all of us, especially, this is a mystery, this world, this financial world. And I'm just trying to make it simpler for you, only because it's that simple. It really is. And it kills me to this day, in 2021, nobody talks about it. I still can't believe it. Nobody's even willing to address the issue. In fact, I say to myself, I'm doing this channel. I'm doing this out of the box. I don't sell anything. I don't have a newsletter. I don't have any room. I could care less about subscribers. I'm doing this because it makes me feel good. And I never had, as you've been following me at all, I never had this advice from my family, my father. I come from a successful family. I never got this. And it makes me feel good. So of course, what would I do if I had, I'm a nobody, I have no following. But remember, some of these people have all these followers and subscribers. They started 15 years ago, 14 years ago. The problem is PK I'm 62. I'm already an old goat, but then I'll be a mummy. And I can't stand those Florida mummies. This is my biggest nightmare, turning into a mummy. Why do you think I go to the fitness 6 days a week? So anyway, but listen, one day, if I had that opportunity, I would love to debate a financial planner, somebody to debate this issue, and you listen for yourself, and I'll put these questions, exactly what I'm telling you, and you'll see the answer for yourself. I will put every one of those questions to them about diversification. Why are you doing 60-40 asset allocation? These are the two. These are really the two issues. That's it. So I'm saying, if you want to pay 1%, 0.5%, you feel more comfortable, that's okay. But evaluate every 2 years and see where you stand. And don't be impressed that he did better on a losing year. Only be impressed that your advisor outperformed the S&P. Not underperformed, but they all make a big deal on the losing years. The market was down X, I did better. You're down. You shouldn't feel so bad, you should feel lucky. Lucky, they're losing your money and you're paying 1%. Anyway, you get the point. Look at this. 21 minutes, gone long enough. I think you got the issue. You can write me if you don't understand. This is PK with our Out of the Box, why diversification does not work in your long-term portfolio. I wish everyone a great day. Ciao, everybody.